All right, let's cut through all the noise and hype in the Bitcoin market. Today we're going to explore three really powerful tools that have, historically, helped investors make sense of these massive, super emotional market cycles.
So let's just dive right in, because this is the million-dollar question, isn't it? If you're in crypto for the long haul, how in the world do you navigate these absolutely insane swings without letting fear or, greed completely take over?
And hey, let's be super clear about something right up front. We are not talking about day trading here. The tools we're looking at are for understanding the big picture, the huge multi-year bull and bear markets, not the little day-to-day squiggles on a chart.
Okay, our first tool, and this one is fantastic for trying to take emotion out of the equation. It's called the MVRV Z-score. It's a really cool indicator that gives us a data-driven look at whether Bitcoin is fundamentally over or undervalued.
So what does that actually mean in plain English? Well, it basically measures how much profit the average Bitcoin holder is sitting on. And you can imagine, when that number gets crazy high, the temptation for everyone to sell and lock in those profits becomes absolutely massive. On the flip side, when most people are at a loss, that selling pressure just kind of dries up.
The best way to think about this is like a mood ring for the entire market. When you see it enter that red zone, it's signaling euphoria, it's signaling greed. And that's usually a dangerous time. But the green zone, that often points to fear, to capitulation. And historically, that moment when it feels like everyone has given up is the point of maximum opportunity.
And look, you don't have to take my word for it. The track record here really speaks for itself. This indicator has been shockingly accurate, flagging the major peaks and the major troughs of past Bitcoin cycles. It's a really solid first stop in any analysis.
Okay, so while the MVRV Z-score is a great all-rounder for spotting both tops and bottoms, our next tool, well, it's a specialist. It's called the Pi Cycle Top, and it has one single laser-focused job, signaling the absolute peak of a bull market.
Yep, it's not designed to find bottoms. It won't tell you much about the middle of the market. Its entire purpose is to signal that final, frantic, blow-off top stage of a bull run, and it often does it just days before the absolute peak.
So how on earth does it do that? Well, it's actually pretty clever. It compares a fast-moving price average with a much slower one. A good analogy is to think of the fast one as a sprinter, that's the short-term hype, and the slow one as a marathon runner, representing the long-term trend. Normally, they're miles apart.
But imagine a moment when that sprinter is moving so unbelievably fast that they actually lap the marathon runner. That's when you know things have gotten completely unsustainable. That crossover is a classic signal of pure, market-wide FOMO, fear of missing out. And it's basically the ultimate alarm bell that the party is very, very close to being over.
And its record? A perfect 3 for 3. It is called the top of the last 3 major bull cycles. Pretty incredible. Okay, so we've looked at the market from the investor's perspective, and we've looked at it through the lens of pure price momentum. Our final indicator, the Puell multiple, gives us a completely different and totally crucial angle, the behavior of the Bitcoin miners themselves.
So why should we care about miners? Well, because they literally control the faucet. Miners are the ones creating new Bitcoin every single day, so their decision to sell or to hold has the most direct impact on the new supply that's hitting the market.
What this indicator does is pretty simple. It tells us when miners are getting paid exceptionally well compared to what's normal for them. And it just makes sense, right? When their daily revenues go through the roof, they are way more likely to sell their newly mined Bitcoin to lock in those massive profits.
So this gives us a direct window into the supply side of the equation. A high multiple up in that red zone is a big warning sign that a wave of selling from miners could be just around the corner. A low multiple, down in the green, means miners are probably holding on tight, restricting supply, and maybe even setting the stage for a price recovery.
All right, now for what I think is the most important part. As powerful as each of these indicators is on its own, you should never, ever use them in isolation. The real insight, the real confidence, comes from seeing them all work together.
So let's just recap. You're combining 3 totally different perspectives. You've got the average investor's psychology with MVRV, you've got pure market momentum with Pi Cycle, and you've got the producers, the miners, with the Puell multiple. When all 3 are flashing red at the same time, or all 3 are deep in the green, well, that's a much more robust, high-conviction signal about where we are.
So, the key takeaway here is to use this to build a strategy. This isn't about becoming a perfect market timer. because nobody is. It's about using these tools as a guide to methodically reduce your risk when the signals are flashing red and to act with a bit more confidence when the data is showing a potential historic opportunity.
And really, that's the whole point. The goal is to shift from making emotional, reactive decisions to having an informed strategy. It's about being prepared. These tools help us stop asking what's the price going to be tomorrow and start asking the much better question, are we prepared for where we are in the cycle today?
Hey, thank you so much for joining us for this explainer. If you found this useful, a subscription and a like would be really appreciated. It helps us create a lot more content just like this.